In this explainer video, we're going to review the 5 basic rules associated with a 1031 exchange. First, what is a 1031 exchange? Under United States Tax Code 1031, this permits an individual to sell a property and potentially defer their capital gains into a property of equal or greater value, or potentially multiple properties. So in other words, this is a tax strategy that can be used for real estate investors. So let's jump into the 5 rules. The first thing you need to understand is what's referred to as net selling price. So this is the selling price of the relinquished property. So the property that you're selling and you want to roll the capital gains into another property or multiple properties of equal or greater value, those are referred to as the replacement properties. So the net selling price is this. The net selling price would be equal to the selling price minus any title fees and realtor commissions. So let's use an example. Let's say the net selling price is $200,000. And let's assume that it's a rental property that you've owned for a number of years, and let's make the assumption that you have $50,000 in capital gains exposure. So you don't want to pay taxes on the $50,000, and you know that you want to roll that money into a property or maybe multiple properties, and let's assume that those properties or property is going to be for investment purposes as well. Okay, so in other words, you wouldn't be able to take the capital gains and roll it into a primary residence or roll the capital gains into, let's say, a self-directed IRA. All right, this is a strategy that has very specific requirements. So the net selling price, again, is going to be your selling price minus any title fees and realtor commissions. So using our example, $200,000 sale, and then you have $50,000 in capital gains. Now that takes us to rule number 2, which is what properties are going to qualify. So you can exchange all real estate as long as you hold it for investment or productive use in a trade or business. So there are some specific requirements. This is where it's important that you work with a qualified intermediary. So here at Equity 1031 Exchange, as a qualified intermediary, we have information and education, and we can provide additional resources so you can learn more about this and determine whether you qualify or don't. All right, number 3, you must use a qualified intermediary. So again, that's Equity 1031 Exchange. The regulations state that you use a qualified intermediary, oftentimes you'll hear this referred to as a QI, to conduct the exchange. Now, your QI, they're going to do 3 main things for you. First, they will prepare the exchange agreement. Number 2, they escrow the proceeds after closing on the relinquished property. And number 3, they coordinate the exchange with all closing agents. So in other words, using our example, $200,000, you sell a property, that $200,000 must go to the qualified intermediary. Meaning if you took receipt of that $200,000, you would not be able to roll your $50,000 in capital gains into another property or multiple properties of equal or greater value. So you have to use this qualified intermediary. All right, that takes us to rule number 4, which is the 45-day rule. So within 45 days of closing on the sale, again, that's called the relinquished property. So within 45 days of closing on the sale of the property, in our example, $200,000, the exchanger, so let's call that you, must formally identify their target replacement properties. So it may not just be one property. You know, let's say, for example, we have $200,000 going into the qualified intermediary, and then maybe you identify 2 properties and combine those 2 properties are, let's say, $300,000. Okay, so that's more than $200,000, so you would have met the requirements of equal or greater value. So again, not just one property, it could be multiple properties. Within 45 days, again, you have to identify up to 3 properties. And if you want to identify more than 3 properties, there could be some restrictions that apply. So we would want to look at that in a little bit more detail. All right, so that's the 45-day rule. You need to identify a certain number of properties within that 45-day period. The last rule, rule number 5, is the 180-day rule. So you must close on one or more of your identified replacement properties within 180 days. Now that's 180 calendar days, not business days. So you have to meet the 45-day requirement, and then the 180-day requirement. So you have a bit of a short window. However, there are thousands of these transactions that occur on an annual basis. So oftentimes investors, before they even list their property or consider selling it, they're already looking for some of those replacement properties. So you just want to make sure you're disciplined and you have a strategy with respect to selling the relinquished property and then replacing that with the, as it's called, replacement properties. Lastly, I will mention that there is another strategy within this 1031 exchange referred to as a reverse 1031 exchange. Now, this requires a lot more attention in detail, potentially more costs, but what it could potentially allow you to do is, let's say you find a property that you want to purchase, but you don't have enough time to sell the relinquished property. You could potentially, assuming you have the cash, you could buy the replacement property first, then sell the relinquished property, and using a qualified intermediary, you could still consummate that transaction and defer your capital gains. Again, that's known as a reverse 1031 exchange. So again, that is the 5 basic rules associated with real estate 1031 exchanges. Reach out to Equity 1031 Exchange for more information on this subject.